When it comes to whole life insurance policies designed for cash value accumulation, everyone wants to use their money as efficiently as possible. They want to grow their policy. And a lot of questions that we get are related to, can I grow my policy by paying back my policy loan? And that's exactly what we're going to cover today. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
So let's start by talking about what is a policy loan. And very simply, a policy loan, when you take it against your cash value, is a loan from the general account of the insurance company. So you build up the cash value within your policy, and you're able to collateralize a loan against that cash value from the insurance company. So the insurance company is giving you a totally separate loan, placing a lien against your policy, and now you have access to that money on a tax-free basis.
Yeah, and the great thing about that is your money never leaves the policy. And as such, you get to continually earn uninterrupted compounding on the value inside your policy. But also, you are getting a loan, and that loan will require loan interest to be paid. So while you could grow your business by using policy loans, you can't grow your policy just by using policy loans.
Exactly, right? Because we're not impacting the growth within the policy at all. We're not making it any better. We're not making it any worse by taking this policy loan. But what needs to be considered is the interest being charged to the policy being paid to the insurance company. Now, with mutually owned life insurance companies, as it relates to your policy, you're part owner of that company. So what that means is if the insurance company is making a profit, hypothetically, a part of that could be passed on to you as the policy owner in the form of a tax-free dividend.
Yeah, and more specifically, you're part owner of the company as it relates to your policy. So any profits made on your policy, the insurance company will funnel back to you in the form of tax-free dividends. And so that's a nice little added bonus or benefit. But make no mistake, you can't grow your policy just by taking loans.
So with that, you have the opportunity to take advantage of opportunities, whether that be in the traditional market, whether that be in crypto, whether that be in real estate. No matter what the opportunity, you have guaranteed access to take advantage, especially when it comes to a small business owner. Being able to access money on your terms is a huge deal.
Yeah, so again, it's all about access to capital. You will have improved or increased access to capital by having money in a life insurance policy, and you can use that access to take advantage of opportunities, to pay off debt, to buy equipment, to hire new personnel, all of the things that as a business owner you struggle with because you don't have access. Now you have this policy, and it's almost like you have increased access exactly at the time you need it.
Yeah, exactly. And it comes down to having that foresight and the discipline to make those simple shifts in how you're using your money to put yourself in a better financial position going forward, right? Because a lot of times with these whole life policies, it takes time to build up all of the money that you're putting in. It takes time to get there. So having the foresight and discipline to put that money away on a monthly or annual basis is going to be a huge deal down the line when you actually need access to money to take advantage of these different opportunities that only come up, by the way, if you have access to money.
Yeah, that's a great point. And so if loans don't grow your policy, how can you grow your policy? And it's real simple. The more premiums you pay, whether it's the base premium or the paid up additions rider, the greater the cash value will be, the greater the access to capital will be for you, your family, and your business.
Yeah. And the question really becomes, how soon would you really want to stop putting money in the policy, especially as this train starts chugging along and gaining momentum as they naturally do on an actuary basis? Why would you want to stop putting money into the policy if you're putting in $10,000 and have access to 20 immediately without taking on any additional risk?
Yeah, and let's be specific here. It's not going to happen overnight, right, where you put in 10,000 and the policy grows by 20,000, but could be after 8, 10, 12 years, you're paying that $10,000 premium and boom, your cash value grows by 20,000. Well, that really puts you in a great position. It's almost like $1 became $2, and now you have access to $2 that you can use to run and grow your business.
Right. And that's the key point, right? Time takes time, especially with these policies, because we're not taking on a risk. We're not using it as an investment. We're using it as a vehicle to save and to have guaranteed access to money down the road. And unfortunately, people could look at the early years and say, oh, that's a horrible investment. But what should be seen is, and what often can't be seen, is what happens down the road when you're making these capital inflows of premium into the policy and have that nice growth of cash value without taking on any risk and without giving up access to that money.
Yeah, we always tell people that, owning a specially designed whole life insurance policy designed for capital accumulation could be the best asset you own when you're in your 60s.
Absolutely.
But the catch is you have to buy it when you're in your 30s and 40s and 50s.
When you're not thinking about money in your 60s necessarily, right?
Exactly. But again, the point is you don't grow your policy by taking loans. You only grow the policy by paying more premium.
Well, let's bring that back to then what's the point of paying back the policy loan? Let's dive into that question.
Well, again, it's all about access to capital, right? So when you take the loan, that reduces the equity that you have in the policy. And as you pay that loan back or you pay the loan off, now you'll have more equity available in the future for other demands of your cash flow or other demands for capital.
Right. So if you're able to take a policy loan and avoid higher interest on a credit card, or take a policy loan and make a capital investment in your business, or take a policy loan and take advantage of another opportunity that's going to earn you a higher rate of return, certainly take advantage of that. But when that money comes back, put it back towards your policy to reduce that interest and increase your access to the capital going forward. It's as simple as that. So if you'd like to learn more about how to grow your whole life policy or get started with your first specially designed whole life insurance policy designed for cash value accumulation, visit our website at tier1capital.com. We'd be happy to hop on a free strategy call with you to show you exactly how to put these policies to work for your specific situation and help achieve your goals now and in the future. If you like this video, be sure to check out these two. We picked them out special for you.
Thank you so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.